Hello there everyone, today's video is all about mileage claims. Now, mileage claims, you may think, hey, 45p a mile, what more do you want to know? End of video, right? But it's, listen, it's a little bit more complicated than that. As you can see, I've got a full whiteboard full of info. So, mileage claims. Now then, let's get in the nitty gritty. Mileage claims, in terms of tax impacts, 3 taxes: income tax, corporation tax, and everyone's favorite tax, VAT. So let's start out with the thing that a lot of people know about, 45p a mile. So you've got your own car and you're driving for business, whether it's your limited company, your partnership, your employer, you're using your personal car and you're making a mileage claim. 10,000 miles, 45p a mile. So you put a claim in. That's how much you can get paid, right? That's how much you can get paid without it. If you get paid more than that, it's a taxable event, right? So up to 10,000 miles, 45p a mile, then 25p a mile thereafter. So it's quite a generous amount, and it's meant to cover not just petrol or diesel, but costs of repairs, the MOT, servicing, all that kind of stuff. So just assuming that you did do exactly 10,000 miles, that's £4,500 a year. Now, let's assume that you are a director shareholder, you have your own limited company. So what does that mean? It means you put in a claim to your own business and you essentially say, look, I've done 10,000 business miles, please can you pay me £4,500? Thank you very much. Now, chances are you do it over 4 quarters rather than once a year. I mean, a lot of people do it once a year, but it's better to do it more often than that. But if on those numbers, £4,500. So what happens? Well, that is a credit on your director's loan account. So the company owes you £4,500. So it'll sit there on the balance sheet as a liability, £4,500 owed into the pot, paid out as and when the company can afford to. It's very rare, although it's not insurmountable. I mean, it can happen that literally you put in a claim and pay it straight away. Most people just credit it to their director's loan account in the mix and draw down on that DLA as and when. So that's what you do if you're a director shareholder. What about if you're an employee? So you're an employee and your employer is paying you less than the authorized rate. So let's say you are a employee and you're getting reimbursed 35 pence a mile. You say your firm has just got a policy of a flat rate. They say, don't care how much mileage it is, we're going to give you 35p. Okay. So in this case, assume you've done 10,000 business miles and you've got 35p per mile reimbursed from your employer. So you've received that, but you are being shortchanged because you can get up to 45p a mile. So what about claiming the difference? Well, this is how you do it. You do it on your tax return, or if you don't do a tax return, you get on the phone to HMRC, tell them about it, and they will adjust your tax code to basically give you that relief by deducting less tax on your payslip going forward. So the crucial thing is, and a lot of people misunderstand this, claiming the shortfall is not as generous as just being paid the full amount. So not having a generous employer is not as good as getting a shortfall and claiming the difference with HMRC, because technically you don't actually claim the difference, as I'm about to explain. In this scenario, 35 pence reimbursed. Difference between 35 pence and the 45 pence authorized rate, 10 pence. 10 pence at 10,000 business miles. Well, let me see, that's £1,000. So £1,000. When I say you claim it on your tax return or you call up HMRC tax office, they're not going to give you £1,000. They're going to say that 1,000 will deduct it against your salary. So it's a tax deduction. And if you're a 40% taxpayer, it's going to save you 400 quid. You see? So you're not getting £1,000 in your hand, you're getting £1,000 off your earnings, which reduces your tax by whatever marginal rate you are. If you're a basic rate taxpayer, you're only going to see the benefit of 200 quid. So had your employer given you the amount up to 45p, you've been £1,000 better off. But if they're a bit tight and they're only giving you 35, then you're only going to be 400 better off if you're a 40% taxpayer, or only 20%, 200 quid if you're a 20% taxpayer. So this shortfall, this misnomer that you're going to get it all back anyway, you're not, because HMRC will let you have the amount as a tax deduction, not an amount of tax. So you are much better off negotiating with your boss to say, hey, come on, you know what the rules are. You can do me 45p, thank you very much. That's what you're better off doing, rather than messing about and claiming everything else. Yes, if they're not going to acquiesce to that, then this is what you've got to do. You've got to do it through your return. But just have the expectations that you ain't going to get that full reimbursement, because it doesn't work like that. So that's income tax. Second tax is corporation tax. So coming back to one of the scenarios, if you're a director shareholder of your own company, you got a little bit more control in all of this stuff. So CT deduction. So when I come back and I said, here, look, you put in your chitty to your own company, you say, dear company, pay me $4,500 for 10,000 business miles, thank you very much. So from a double entry accounting, we've already said the credit goes to the director's loan account. We mentioned that in the first bit, but where does the debit go? Well, the debit goes to the profit and loss account in motor expenses. So you're going to debit the P&L, credit the balance sheet, and that debiting the P&L will save the company corporation tax. So you've got your hands on $4,500 tax-free. The company's got a tax deduction of $4,500 multiplied by the corporation tax rate, which, assuming you're still at 19%, I know it's gone up for certain size businesses, but 19% is easy, easier for the math. Well, actually, no, a quarter is pretty easy to work out, but 19% on $4,500 is, have I written it down? Well, look, it's going to be about 900 quid. So you're going to save £900 corporation tax on that mileage claim. Fantastic. So, what am I saying here? Yeah, 800. Can't even read my own writing. £855. So, corporation tax deduction. Company gets tax relief on paying a tax-free mileage to you. Now, what about the next tax, which is VAT? And I would suggest not a lot of people know about this. So, if you're a director shareholder, you're probably familiar with putting in a mileage claim, getting your $4,500 or whatever. If you've done 20,000 miles, you'll get a blended rate of some at 45p, some at 25p. But the company, when it pays you the money, can also claim VAT back on those payments. And it's a little bit tricky and it's a little bit fiddly, but I'm going to tell you how you do it. So, what we have to do is look at HMRC's published tables. So HMRC have a set of tables, and they actually update them every 3 months. So unlike this 45p a mile, which has been in for decades, the tables, on the other thing I'm going to say, are updated every quarter. And what it is, they give you figures for fuel for certain sized vehicles. So the first thing you would do in this scenario, yes, you've done all this stuff, and then you look at the VAT. So you say, right, I drive a petrol engine car, and it's a 2.5 litre engine car, and you go to HMRC's tables and it'll say, right, 2.5 litre petrol car, that is, I don't know, let's say it's 16 pence a mile, right? And it's normally in the teens. And it's, remember, this is just to cover fuel, right? Not the 45p that covers everything else. So what you do then is you say, right, let's just assume, actually, it's 15 pence, right? Like I said, most of these things are in the teens, 13, 14, 15, 16. So 15p a mile for fuel. So in this scenario, let's take a guy who's done 3,000 business miles. 3,000 business miles multiplied by 15p based on the type of car that he drives per HMRC's tables. Then you say that, then you've got to divide by 6 because it's the VAT fraction working backwards. Most people are familiar with the VAT, you add 20%. But if you're starting with a gross figure, to go from gross to net, you've got to divide by 6 to work out what the VAT is, not started with a net and a fifth to add it on. When you're working backwards, you divide by 6. So we assume 3,000 at 15 is the gross, divide by 6 gives us 75 quid. So 3,000 business miles, say in this quarter, first quarter, £75 input VAT that can be reclaimed. So, what have you got to do it? Well, you have to keep petrol receipts with the bit that says the VAT amount at least equal to the amount of VAT that you're claiming. So let me just repeat that. This is like the only thing I can think of in the VAT world where you don't need a VAT receipt where the VAT element mirrors the amount you're trying to claim. Because normally everything else on input VAT, you get an invoice that something that you've spent, and it's there, it's black and white. It's, look, you've spent 100 quid plus 20 quid VAT, so you're going to claim £20 VAT back. With this, it's completely different because it's fiddly. You've got to work out how many business miles and everything else. But when you go to the petrol station, the petrol guys don't care how much business. They just give you a receipt for when you filled up your tank. So HMRC are quite pragmatic on this to say, look, if you can just collect all your petrol receipts, even though you're paying for both personal and business, doesn't matter. If you've got petrol receipts, which are VAT receipts, which have VAT amounts on them, just collect them in a pile, and as long as the total of those receipts, the VAT bit, is more than what you're claiming back, that's good enough for them, right? If you ever got a VAT visit. So that's what you've got to do. Like I said, it's the only thing I can think of in the VAT world where, the stack of those receipts, if you add them up, could be way over the 75. Doesn't matter. You're only claiming that, but as long as you've got enough evidence, as long as you've suffered enough VAT in the quarter, that's what HMRC will let you do. So, on there then, what you would do, you claim your VAT back, and then the double entry accounting for that is that you will debit your balance sheet for the VAT due back, or not netted off the amount that you're going to pay, debit the VAT account, and you credit the P&L. So you've already had a debit to the P&L, saved you a few quid, but it comes back to this mileage claim and the shortfall. You'd rather have the cold hard cash back than have it as an actual deduction. So yes, if you get the refund of tax, the VAT, it's gonna actually mean you're paying more corporation tax, slightly more, but you'd rather have it that way because you'd rather have £75 in your hand rather than a deduction of £75 against your profits. So, hope that all made sense. But that's how the mileage claims work. It's not just, hey, it's 45p. A little bit more involved, depending on if you are a director shareholder, self-employed, or an employee. But do consider all of these things because it's a lot of people forget. So even owner managers, people who have their own limited companies forget to do mileage claims when they've been doing a lot of business travel. Employees don't know about claiming the difference on the shortfall. Sometimes if they do, they get it wrong and they do too much. Like I said, it's a deduction, not a reimbursement. And then a lot of people, I would say the vast majority of people, don't even know about the VAT reclaim on those mileage payments. So this is if you are the employer. If you're the employee, it doesn't matter. This is your employee is all about getting your hands on as much as you can from your employer. The VAT play is just applicable to the employer. So, overview there on mileage claims. If you like this video, and I hope you do, please remember to subscribe. And as always, I'll see you soon.